Hey,
Oh,
Doug.
hey, Chris, there he is. Well, good to see you again. Welcome, welcome.
Yeah, thanks, Doug. You look like you're some kind of like super sophisticated video blogger with that lighting.
Well, I've got a podcast show that I
There you
do.
go.
Yeah,
See?
that's definitely part of the shtick. So, yep, check it out. It's called Leadership Powered by Common Sense. I'm on all the main streaming services and on YouTube.
Oh, nice.
So, yeah,
Everybody's got a side hustle. I need a side hustle.
yeah, it's I just got word I've cracked into the top 1% on Apple, so I'm pretty happy about that.
Nice. But doesn't that mean like you're like
I'm one
number?
of about 150,000.
I was going to say
Yeah,
it's 1% of a very big
yeah.
number.
But thanks for pointing that out. What are friends for, right?
That's right. That's right. Can't
Top
get you.
1%. Top one
Can't,
percent sounds a little better, right?
can't let you get away with that.
Yeah, yeah. That's right. No, that spoken like a true numbers guy. So good for you. Well, on that cheery note, I want to go ahead and get started. Respect everybody's time. I know it's a holiday weekend and others may have big plans. I certainly hope you're going to get that opportunity. But we are privileged here to have Chris Mooney from Acquira Capital sit in. We asked Chris to come on board maybe, I don't know, once a quarter, once every 4 or 5 months, something like that. Um, a lot of our material talks about the availability of access to Acquira Capital. But I'm going to let Chris just give kind of his overview, his explanation of things. And as we said, Chris, maybe, I don't know, 15, 20 minutes tops, and then we'll kind of open it up for Q&A and let everybody pepper you with their curiosities. So with that, I'm going to say welcome to Chris Mooney.
Yeah, thanks, Doug. Appreciate it. Hi, everybody. I may have met some of you already as you have entered your deal search and have talked to me about various sources of capital. We are a kind of specialty private equity fund. It was specifically designed to support acquire entrepreneurs and co-invest along with the SBA as part of your capital stack, typically in the form of preferred shares. Quick lesson on preferred shares for those who don't have it top of mind. Preferred shares sort of have one leg in debt, one leg in equity. And so we typically will see is some kind of a paid or accrued coupon on the equity investment that acts like interest. And then there is the equity itself, which is an interest in the residual earnings of the firm. So preferred is a very common investment vehicle, both in venture capital and private equity. And that's the principal interest that we use. We are not a debt fund. We can't really issue debt. So we only do it on an equity basis. What we try to do is, what we succeed in doing is deploying what could be a significant amount of capital relative to your equity injection without asking for a controlling interest in your firm. So sometimes folks get involved with investors and the investors start asking things like control of your company, and you get the right to work hard and try to earn some of it back before it sells. And so that's what we typically would see in, I lost the term, search funds. That's right. Search funds will use that method where they come in, they post most of the capital for the transaction, and then they will have a control, and you as the become their employee essentially as the CEO of the company, and hopefully if you work really hard you'll be able to get a little bit more than maybe 10% of the business back. We flip that over on its head. It's a little bit of a disruptive business model. We actually give you credit for the SBA loan. We recognize the fact that you're being asked by the SBA to post a personal guarantee, so we actually give you credit for that in the equity calculation. And so we end up with something typically south of 20%, but we could post up as much as 80% of the equity. And so it flips the model on its head. Now, the money's not free. We do have an investment model. We do have a thesis, and I'll go through that pretty quickly. But we think it's a much more fair outcome because we believe we're here to support the distributed ownership of businesses. And by getting these family-run organizations to you as a new professional leader, as you transform them into management-led organizations, we know there's an opportunity for growth. We know that we believe that that will be the source of return for our investors, our LPs. And in many ways, we are investing in you as much as the business. And so we want you to be in control. We want you to drive your own destiny on your own growth. And we're there to advise and be a friend in need, if you ever need one. And you get to use our capital to help grow those businesses. And so it's a pretty compelling model. It's kind of unique, mostly because we have this, this hands-off attitude of, we trust you with our capital. We will be there for you whenever you ask, but we will not impose ourselves on you. We are not the owners, you are. And we're going to set you up for success to run and grow your business. That really is it in a nutshell. When we think about the kinds of investments we like, right, we can't invest in everything. I have to represent to my LPs, I have to give them some definition, if you will, of what I will do with their capital when I invest it. And so we look at 3 segments. We used to be 2, but now we're really 3. We look at home services, we look at manufacturing, and we look at infrastructure. And each for their kind of their own reason. Home services obviously is the sweet spot for Acquira. I would imagine that most of you are seriously entertaining, plumbing, HVAC, electrical. Those are great businesses to be in. You can learn a lot about the why as part of the coursework here. Great businesses. We also like manufacturing. Manufacturing is my personal favorite. It's a passion sector for me. We have in our first fund, we have 3 manufacturing businesses, and they're all doing quite well. And we also like the fact that manufacturing businesses that develop products typically have very preferred tax outcomes on sale if they're structured correctly. So we do like manufacturing. So definitely earmark those opportunities if you're thinking of approaching us on an opportunity. And the third is infrastructure. Infrastructure was really a play on leveraging my background. I have 25 years in wireless infrastructure and portfolio management. And a lot of that time was also spent in corporate development. So I have done a lot in fiber, telecom, telcos, infrastructure deployment all over the country. And so it's an opportunity for me in my GP seat to add value to a portfolio company through my book of contacts. So for example, we just made an investment in SPF Underground Utilities a few weeks ago. And part of that long-term business plan is once they get through the ACE process. Doug, are you leading the ACE on that? Is that one of your?
Dana Bickford on my team. Oop.
Okay.
Yeah, Dana Bickford on my team is doing that.
Okay. Well, once that gets digested and operating, in my old life, we bought all the fiber from Florida Power and Light, the entire state. It was like a $7 billion deal. This company is based in Florida. Their #1 customer is Florida Power and Light, but only for electrical and some telephone. So one of the things that we're going to do with our partnership, now that we've made the investment, is we're going to get SPF Underground Utility into fiber infrastructure. And we're going to start hooking up data centers and communication towers, and we see it as a real opportunity. And so when we think about how the fund deploys capitals, we really like it when there's a kind of a 1-2 punch to the return model. Not only do we supply the capital that helps make your deal kind of work and stick together, but we like to inject our experiences and our opportunities and our contacts into the mix so that you're getting more than just capital, right? You're getting an advisor and you're getting a partner. Because, Acquira is going to do their thing and they're going to be helping you along, and you're going to take capital from us. It's a 10-year relationship. It's a 10-year fund. And so if you hold on to the capital for the entire time, we're probably going to call each other a couple times a year for the next 10 years. So we like to think through those opportunities. One of the questions I always ask is, why our capital other than it being capital? And thinking through how that might impact your business plan and what resources we have. In some ways, it's an opportunity to pitch to you why our capital is a good investment in your strategy. Because not only are we trying to solve maybe a gap in your capital strategy, but there may also be a really compelling growth partnership, like the example I just gave with SPF Underground. And that's why we have sort of earmarked infrastructure as the third segment of our investment thesis. And I think it's a good example of how we can drive value. So Doug, I think that's pretty much it. Otherwise, we start getting into really nitty-gritty details that'll probably get horribly boring. So we could maybe pause for a question or two.
Well, let me interject. One thing I'd like you to address, and to help clarify, I want to draw kind of the bright white line between Acquira, the training and support firm, versus Acquira Capital, the funding source. Can you share your version of that story?
Yeah, sure. And to help, actually, we're going to change the name of Acquira Capital because we have some branding confusion. So Acquira Capital is a group of partnership documents of a fund that is, I am the sole general partner. Acquira, the educational portal and everything that you're participating in, is actually operated by an entity called Kingmakers Inc. My entities are currently Acquira Management Company, Acquira Fund 1, Acquira Fund 1 GP LLC. And so we want to separate my investment business, especially in the name, so there's no confusion as to the fact that they're actually separate companies, which is an important distinction, as Acquira, as you know it, has evolved. It's much more than just an educator. It is more appropriately defined as an M&A advisory firm. And because of that, and the way the rules have changed, we think it's best that we change our name as a fund to give Kingmakers sort of an opportunity to use that name more freely. And then we will be able to distinguish ourselves more clearly. So actually, our new name is HMH Capital Partners. We're working on the regulatory filing for that. And so you'll see the Acquira Capital banner disappear. It'll be replaced by HMH Capital Partners. I'm doing some work at the GP level. The investments will continue. Acquira is going to continue to be the principal source of deal flow for the work that we're doing. So the opportunity to invest is not changing. We're just making some clear divisions so everyone knows, sort of in the public eye, that the investment vehicle that I represent is a separate legal entity from the Accelerator program that you guys are all part of.
Yeah. So it is a kind of commercial relationship, not too different from what you're going to do when you build your individual relationships with your SBA lender bank. It's a relationship you're going to build that happens to have access to capital involved. So that is always something I know historically there's been a little bit of confusion about that in terms of what's published on the web and various articles and such that have been posted. But always, like, every time we get a public forum and an opportunity to talk about that distinction, it is very much a difference with a big distinction. So we want to be sure that everybody's clear on that. So with that, I'll open it up to some other questions, or maybe I'll start, Chris. You mentioned the industry segments, and what else do you consider sort of parameters for eligibility and serious consideration of being a player in the fund or with the fund?
We actually rely pretty heavily on two sources of vetting. One is, I have a healthy respect for anybody who can get through the acquirer process with a closable deal. That shows grit, perseverance, fortitude, intelligence, personality. It proves all those things out. What you endeavor to do is difficult, and you have to have a great deal of intention to get through a business acquisition. And so the very fact that you can get to the finish line is a big underwriter for me. We also rely heavily on SBA underwriting. We often will review very much the same things you're going to prepare for the SBA. There's no point in doing double work. So I think whatever the due diligence is to borrow several $1 million is probably sufficient to borrow or have an investor of a couple $100,000. Right, it's typically where we are. Typical checks about 200 to 400 grand. We'll go higher if we need to, but that seems to be the sweet spot. So clearly, if you're passing the bank due diligence for a $3 or $4 million loan, we can piggyback on a lot of that work. If I think about some of the things where I may just press in a little bit, I'm going to be really interested in the business plan. I'm going to be really interested in the why should you own this business. I am definitely looking for an owner operator who values their investors' capital and has a clear view on how that capital will be returned. And you don't have to have all the answers. We can have a collaborative conversation about that, since many of you will be new to professional investing. And we can have great conversations about your business plan and how actually you're going to cycle cash back to the fund as an investor, back to yourself as the owner, and have a just really clear view. And then, as I mentioned earlier, I'm really keen on, well, can we add value to your transaction beyond the cash? And having an understanding there. Sometimes we just have a vague notion. We sort of get comfortable with, yes, we know we can help. And we may actually use the ACE integration program to help clarify the particular needs of that business and to see where we can help press in and help you to fill out your business plan. But we want to have an idea that there's a value add beyond the capital. I think those are the key pieces, Doug.
Yeah. And if I may interject on that note, for everybody on the call, to give you a sense of the timing of things, I and my advisor team, typically, we don't make the quick introduction to Chris until after you've gotten through the early stages of the Accelerator program and have potentially put together your first investment committee deck for us inside of our program. And we do that in respect of, Chris is a busy guy. He's got a lot of things going, and we don't necessarily want to send everybody over there knocking on his door. And that's not to say we're attempting to pass some kind of judgment, but we want to have the first round of discussion with you about how well prepared are you to go forward with your deal. And it's sometimes it happens that a new AE will join our system. They'll start the training. They'll attempt to prepare for the IC and just not quite be there. The story's a little loose. It's not tight enough to ask Chris to invest some time looking at it. He is not there to be an initial coach. As he said, he wants to provide value in the long run, but he's not there to be a coach and help you figure out how to do a pitch and how to get things done. So we try to cover that in the early stages of your journey on the Accelerator program. And as some of you who have already done it know, it can be a fairly quick turnaround in terms of timeline to get you through that gate and referred over to Chris if in fact you're interested in talking to him about his opportunity there. Everybody, does that track with everybody? You understand what I'm saying? Anybody got any question on that or pushback? Okay. I'll open it up for any other questions. If anybody's got anything, either raise a hand or just, oh, Mark, you're there. Greetings, my friend.
Hello. Hi, Chris.
Hi, Mark.
Yeah, thanks for the intro and overview. Just for understanding how the funds that are deployed can be used, is it really more so just helping with like deal financing and down payments, or can some of the funds from your side of the fence go into investments in the business like talent and technology?
Yeah, so that's a really good question, Mark. Thanks for asking. We have viewed the fund as an acquisitions fund. We're there to help you finish the stack. Understanding that once we've made an initial investment in a company, even when my investment window closes, I can make secondary rounds in any existing portfolio company. I can't do it backwards, right? So I can't, I have a finite number of years. I got about 3 years to deploy capital. And if I make an investment in you, we can deploy capital again anytime in the fund's 10-year life, right? So there could be an opportunity for growth capital later on. It would be in the form of equity, not debt, but it is an opportunity to do a growth equity investment. If I don't invest in you and the portfolio window has closed, I can't then subsequently make that investment. So I think it's better to think of us as an acquisitions facilitator, right? An investor at the day one, but that does open up some optionality in the future should the need arise.
Got it. Makes sense. Thank you.
Anybody else?
Chris, this is Dana Bickford. Quick question. I just spent some time with your new investment, and it just as a follow-up, looks like a great company. Gerald is going to do wonderfully with that company, and he's got a super team there. And one of the questions I have for you is, what's the if you're asked to come in for a second round, what would be the sort of the maximum size investment you would consider going in with?
Yeah, so we want to be always mindful of diversity within the portfolio.
Mhm.
We don't want to be too overweighted. So I would probably be hard pressed to do anything over 500,000, given the distribution of capital across all the other investments, because that could put one of the investments in the $1 million range, which would be kind of heavy for what we represented to the LPs. Now, if the initial deal was smaller, right, you could probably do a little bit more, because on the whole, you'd be comfortably under $1 million. Or vice versa, if the investment was rather large at acquisition, we probably wouldn't want to put too much more in on the growth equity. Now, what's interesting is, Dana, is that at that point, we would not be the only investor available to the entrepreneur.
Right.
So one of the things that we built into our fund is syndication rights for all of our highly subscribed investors. So any LP that's into the fund at 2 times the minimum or higher would get an invitation to do a syndicated investment for growth. So for example, let's say that someone needs $1 million for the growth equity. The fund may say, okay, look, I'm going to cap this one out at the fund level at 500,000, but I'm going to invite all my top LPs to do a direct investment, and I would create a syndication vehicle, and I would make basically an entity, 500,000 from the fund, maybe 100 grand from 5 of the LPs who want to go direct, and I would syndicate that back into the investment. So there are levers that we can pull to increase the sort of the caliber of the fund's ability to deploy capital for growth equity in those scenarios. And so we do have that syndication program, and it's one of the attractive features of the fund. A lot of people are interested in that because we believe that our investors are going to get really keen on a sector. And I know I got 8 guys in the fund who love HVAC, and we may have an opportunity to syndicate an HVAC deal, maybe do a bolt-on acquisition or something like that, or make a large capital infusion, and we may have LPs go direct. And so we do make that available as well. Haven't done it. We're too young in the investment timeline because we're still in the investment period. But once it closes, we can do the syndication vehicle.
Sure. Thanks.
Alex, you've got a hand up.
Thanks for joining us here, Chris.
Alex, we're having a hard time hearing you. Not quite yet. Okay. Any others? Any other questions?
Can you hear me now?
There we go.
Oh,
There
yeah.
you are.
All right. It's always the challenges with Bluetooth, especially when you're in a car. If there's competing resources, right? Yeah, Chris, thanks for joining us. I have two questions. One for a few folks that have been lighting up Slack with some questions. Hopefully they get a chance to listen to it later and they can get their definitive answer on, I think I understand it, why indeed that ROBS is not an option for, your fund. And then my second question, my wife is curious about is the times that you don't invest and why, and then, what percentage of deals that are presented to you that are actually funded.
Okay, so let's start with the ROBS. The fund actually can invest in a ROBS deal. The challenge is, and if you're comfortable with it, I can get comfortable with it, is that under ROBS, you can only file a C Corp with a single class of shares. So there's single class of shares.
Yeah, I'm
So
sorry.
your
What is the acronym you're saying? You're saying ROBS?
ROBS, it's rollover for business acquisition program. It's using your 401k to buy a business.
Okay, got it. Thanks.
Right? You either buy it outright in your 401k, you borrow money, you can do half 401k, half cash, whatever you want to do. But that's the program, the ROBS program. And so there are very strict rules by the IRS into how you can access that capital. And one of the sort of the firm structures is that you got to have a C Corp and you got to have a single class of shares. And what that does is it prevents kind of gamesmanship, because people could be tempted to create multiple classes of shares and potentially give the 401k account a lower class of share that doesn't have dividend rights, and then give themselves privately all of the shares with dividend and payout rights. And what you're essentially doing, which is a no-no with the IRS, is you're taking benefit personally from your 401k account. Can't do that. And so one of the ways they solve for that risk is they mandate a single class of shares. Well, the fund is set up to issue preferred shares. We have a series of covenants that help protect us against fraud, bad actors, and various other prudent governance principles that we apply to the preferred shares in order to prevent or to protect our investment in lieu of the fact that we are not in control. Right? So there has to be some kind of a governance program. And we've succeeded in doing that through this specific share class. So ROBS is a complication because our investment thesis automatically assumes a 2 share class structure minimum. Now, I can get over a lot of that and get comfortable with a single class of shares. We probably have to have the governance document structured outside of the share class. But what it also does is it kind of takes away, it limits my ability to get a different outcome than the entrepreneur. So if everybody has the same share class and everyone's paying the same share price for that share class, if I put up 2/3 of the capital, does that mean I get 2/3 of the equity do I actually now control it? Does the SBA now ask me to sign the personal guarantee because I'm putting in way more than 20% and I have more than 20% of the controlling shares? So there's complications that arise with ROBS. And I think compared to the economics that we ask for under the preferred structure compared to the ROB structure, I think the AE ends up paying a lot more for the capital in the form of equity rights, trying to do it through the ROBS mechanism rather than doing it through the multi-class preferred share mechanism. So it's one of those things where it can be done, but we have to be very careful with the economic consequences of that on behalf of the AE. So my general advice is if you have another way to do it, don't do it that way if you need money from a professional investor, because I don't think you should share your share class with a passive investor like us. So Alex, it's a complicated answer. I know why maybe some of my, it could be interpreted as that you can't do it. I just haven't found a situation where I would advise doing it. But if there are no other capital sources, potentially we could figure one out. I just haven't seen one get to the success point yet.
No, I appreciate you taking the time to answer for some other folks.
Yeah, no worries.
And maybe it's a one-off, but is similarly related, Chris. From time to time, we have A's that come to us with the thinking that part of their capital stack is going to be executing funds from a HELOC. And I know we kind of traditionally end up having some extra discussions about that. Do you have a particular opinion or mindset on that being part of the stack?
Actually, no. The HELOC thing is more of an SBA hang up.
Yeah.
Right? Because they're going to say, okay, if you want to use debt for your equity, in the form of a home equity line, they're going to ask you to prove income outside of the business that can service that debt so that it is not actually debt on the business itself. And they
Yeah,
use
we got clarification on that from a lender in regards to the latest SOP from November. Sorry to interrupt you, Chris, but
Yeah.
they no longer require an additional source of income to pay off that other source of debt. So I mean, it's very interesting.
Yeah, interesting. Yeah, so I mean, I wouldn't have an issue with it. I mean, we're equity investors. It may increase your risk of bankruptcy, given the fact you're putting essentially more debt onto the household, if you will, right, in totality. But I just, if the banks are good for it, this is an example of the fund actually leveraging the bank's underwriting standards in order to evaluate that. So it's not going to be a headline topic for me. Certainly we'll talk about it because we're going to go through a sources and uses discussion when we're talking about the investment, and there'll probably be a conversation about why and what are the risk mitigation measures are in place, because you are taking on more leverage in total, but it's not going to be a deal killer for me.
Gotcha. Well, if you will, while we got you, let's talk about the end game. What's the exit structure typically look like, and what are milestones, triggers, timelines, all of that?
Before we move on to that, if you don't mind answering our second question, Chris, sorry.
Oh, sure.
Yeah, so we have 2 deals in the fund right now, Alex. I would say so far maybe 25% of what I've seen is going to get funded, maybe a little bit less. I'm in the terrible habit of showing the AE how to do it without us. So there have been several occasions where I had very ingestible deals, and looking at it, I was like, there is another way for you to do this without selling your equity. And we have those conversations. I guess that's probably bad for me, but we ended up with some AEs with some really great transactions that I could have invested in, but there was another way to solve it that was better for them, and I sent them down that path. So the metric seems low, but we're just getting started on the investments themselves. We've been more busy with fundraising, and in fact, we're still in the fundraising window until I think about February, and we have just started on kind of our 3-year journey to deploy capital. So it's early days, Alex. It's hard to give you a solid metric on that stuff.
Did that answer it for you, Alex?
I think that'll do for now.
Great. Okay, so then if we could, Chris, let's turn to the end game. What are the milestones and trigger points for A's being able to maybe truly get 100% back?
Yeah, so I like to coach the $2 million EBITDA line, because above that point you start to see multiple appreciation, and you really start to see the power of your kind of your organic growth sort of multiply. So anything above 2 million EBITDA is a really attractive exit profile, because you start stepping up in the multiples. That's the key thing. We are long-term investors, so we're not looking to flip this thing in 6 months or a year, anything like that. In our models, we don't assume exits until about 5 years of seasoning. and we have about a 5 to 8 year window in our forecast. So there's a lot of time when you think about how long you have to build a business. In addition, we're always open to be taken out early through a refinance or recapitalization event. So we don't have to stay stuck in the deal the entire time. So as the entrepreneur's needs change, we're always open to an earlier buyout. If we got kind of get to the end and the fund is trying to close, we do have some built-in, this is the covenants parts that we talked about with the multiple share classes, is we do have a liquidation event trigger where we would probably after sometime in year 7, if the AEs hasn't created a liquidation event already, we typically will cause an appraisal of the equity, and then we'll price the business, and then the AE gets to choose. They can either sell the business to us at that point, or they can buy us out at that price. And that's how we would get to a liquidity event sometime before the 10-year investment horizon is over. We put that as a sort of call it a parachute provision. And we believe that the natural growth of the business and the natural course of investment will yield a liquidation event for us much earlier than that. But it is a mechanism we put in place in order to demonstrate to our LPs that we're not going to hang on to the money forever.
Got it.
And that's the mechanism that we put in place to ensure that.
And what about the AE who is joining us with the long-term vision of stacking a couple of these acquisitions together to build their own domain of holding and expertise? What's the opportunity for deal 2, 3, and 4 if they start building their momentum and track record with it?
Yeah, that's kind of the whole point, right?
Yeah. Yeah, exactly.
Yeah, no. There'll be, we're already talking about a fund 3. So there'll be other vehicles that are created. And I know that as this organization continues to create success, you're going to be able to attract other sources of capital. Right. So I'm early. I was an early believer. And there are a lot of people looking. There are a lot of people interested in what you're all doing. And I think there'll be other capital sources available other than me in the next, call it 5 years. If an AE is already a portfolio company and they want to do another deal, I would consider that a growth equity, and I can do that outside the investment window. Actually talked to the owner of our first investment, Kyle Plumbing, earlier this week about capitalization strategy for the second business. And that's kind of like, again, that's how we can add value beyond the capital, is that we can help the AE figure out those expansion moves and the timing. And with all kinds of stuff come to bear when you start talking about your second deal. And you know what? We may have an exit the way that this deal, or we may not. We may double down our investment, right? So there's a lot to learn there, but we are a thought partner and can offer not only capital but guidance on how to structure those things when that moment comes.
Got it. All right. Any other thoughts or questions folks have come up with?
All right, I have one more question about your target DSCR, Chris.
Okay.
Go.
What's the minimum amount that you're looking for, and what's the range that's optimal for the fund?
Above 1.8 is optimal. But I'd look at anything for the right reasons. I'm not heavily DSR driven.
Okay.
I'm more looking at the totality of the investment. Obviously 2 is better. 1.8 I think is kind of down the fairway. And I know that I think SBA will go down to 1.15, which terrifies me. So I try to stay away from the bottom.
Gotcha.
Yeah, I think when we had Alan from FIB on, I think, as I recall, he went down to 1.2, I think was his quote. Not saying he wouldn't entertain slightly below that, but that was kind of his trigger.
when you're talking about these DSCRs, what you're really doing is talking about the multiple. In some ways, the DSCR is related to the multiple, right? So the more you pay for it, the more you got to borrow, and the higher, the lower the DSCR is going to be. So if you got the thing at the right multiple, right, it's going to work. I think one of the things that gets underestimated all the time is how much working capital is actually required and how volatile the cash flows are on a short-term basis. It is too easy to look at a spreadsheet of historical financials and look at a forecast and it's all smooth, right? It's all nice and smooth. Every year it goes up a little bit. Every year my costs go down a little bit, and it just looks a lot less volatile than it really is. And when you essentially are selling 40 to 50% of your pre-close adjusted EBITDA to a bank in the form of a debt, right? That thing is coming, and it's like the payroll is like the heartbeat of the company, right? Every 2 weeks it's called boom, boom, boom. All of a sudden, there's those months when you get 3 payrolls, boom, 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 a little arrhythmia, and then you get a mortgage payment on the same day as that, right after the third payroll payment is due, and it's like boom. You get these huge spikes in your expenses, and that's something to pay attention to. And so I know there's this kind of rush to debt, and I get these SBA loans and they're guaranteed, and I get to do all this great stuff, and they'll loan this money to me. But I would just do it carefully, because selling off 50% of your pre-close adjusted EBITDA before you've had any customer churn or increases in your technology investment expense and your IT and hiring an HR person and also, man, all of a sudden, between your well thought out reinvestment plan and your debt service, all of your pre-close adjusted EBITDA is gone. And you really don't have a shock absorber, potentially, right? That's the risk, right? Try to avoid that. So just think carefully through that. Just because someone will approve a lower DSCR doesn't mean it's healthy and safe for you as the business owner to leverage that much. So try to think through that very carefully and make sure that you are incredibly generous with your working capital calculations and set up as many liquidity vehicles as possible pre-close.
Yeah, what I'll interject, and I'll say it a slightly different way, not so much for the DSCR analysis, but just operating in general, to Chris's point. I think it's safe to say every AE that has closed on a deal in the last year has come back to us and said, I got my working capital projection wrong. I needed more.
Yep.
And believe us, it's not for want of trying, because working capital in and of itself is one of the most misunderstood concepts in the game right now. And brokers don't understand it. They disagree on how to calculate it, what to call it, what to include, exclude, etc. Sellers seldom understand it, other than they are looking at a bank account that may have 400,000 cash, and you tell them that's my working capital, keep it in the business, and they say, nay, that's my money. I earned that. I'm taking it with me, plus the price you're going to pay me. And that's where a few deals have really gotten crossways in getting over the goal line over that negotiation and understanding of the real necessary working capital to make it work. So
it's the biggest road hazard in the first year of operations, easily, because you have maximum leverage and you potentially have a cash pinch coming in the first 12 to 18 months.
Well, and then you compound it with potential external factors that you have no control over. We had an AE late last year who rolled in, got the keys, bought the business, moved in on week 1, and their receivables disappeared, literally disappeared. And they suffered for going into about a 70-day mark. They were calling customers saying, hey, there's payments due, and the customers were saying, well, we mailed them, we mailed them. Well, can you cancel that check and send us another one? And that's a real awkward position to be in as a new buyer, new owner. But what finally happened, almost at the 90-day mark, a mail truck rolled up with about 14 buckets of mail that had been misrouted and lost in the system. And lo and behold, there was about $480,000 of checks
Oh my God.
in those buckets.
Oh, man.
And then the owner had to turn around and call the payors and say, are these checks still good? And the good news was they were, and everybody had said, yeah, no, we didn't do anything with that money. Cash the check, it's yours. And so the big bleed they had for about 5 payrolls went away.
That's
So,
that's a nightmare.
yeah.
That
Yeah.
keep me up at night.
Yeah.
Wow.
Yeah. Well, in this case, it was 2 partners in the business, and they had to go into their personal reserve fund to be able to
To float the payroll. Yeah.
float not just the payroll, but everything, float
Yeah, you're right.
everything.
Yeah.
So point being, and that sounds like a doomsday scenario, but the point is stuff happens. and,
Yeah.
and if you don't have a reserve, you don't have a plan B for that cash, you could well get caught short.
Yeah, it's funny the different dynamic between revenue and expense, because as the operator of the business, you have total control, and you will be able to write checks all day and spend money. No one's going to stop you. You just keep spending the money, right? You do not have control over your revenue. That timing of that revenue converting to cash, right, is kind of its own beast. And you can manage it, right? You can call on people who are late with your receivables, but at the end of the day, you've got to even float that timing of you've got stuff approved in QuickBooks to pay out on certain dates, and you got to manage cash coming in, and there's a lot of volatility with that. So having those cushions, be it a checking account that you're gonna with $500,000 sitting there just in case you need it, great. Maybe it's a line of credit facility, maybe it's a debt, another debt instrument that came with the building you're buying. But just have that liquidity and figure out what you need, double it, and go for that.
Yeah. And I will tell everybody that for those who will subscribe to the ACE change management framework upon purchase of the building or business, we do deploy a finance integrator who does a lot of work with you on setting up those cash flow projection models and tools for doing just what Chris described, keeping track and projecting and assessing. And if you're coming from a world where you've not done a lot of that or don't even know how to do it, no harm, no foul, your ACE integrator will help you get through that part.
Yeah.
So.
And one of the things that we've learned over the years too is sometimes doing an entity deal, even with its risks, you have to mitigate those risks, obviously, but if you can bring over good credit, like a 10 or 15 or 20-year credit history, your access to capital becomes a lot easier. So sometimes, depending on the business you're buying, you do it as an entity, and you can still get the same accounting outcome as an asset deal in small business as an entity deal, but you get access to the credit. If you do an asset deal, your entity is brand new. It's like a newborn baby, and it will have no credit on its own. And access to capital, potentially in the first year or two of operations, is expensive and hard to get because you have no track record under that entity. If you do it as an entity deal, you have a 20-year potentially credit history, and your cost of capital is lower. You'll have existing banking relationships, lines of credit, all that kind of stuff goes with it. So one of the things I like to evaluate in an acquisition is sort of the risk exchange, right? I can do an asset deal and have low sort of inherited liabilities of the prior business, but I have no access to their credit history or other banking relationship because it's a brand new entity. Or I can do an entity deal and step into the shoes of the entity and have that long capital history. And so you evaluate the two. And in most cases, you could take technical risk of an entity transaction and mitigate that contractually right, through enhanced indemnifications and other various vehicles to get access to that credit, because that gives me access to cheaper capital and greater liquidity so that I can weather the storm if I need to. So do that in your analysis, understand sort of the pros and cons and understand your access to capital. I have seen asset deals where you can actually get good access to capital. Like a small local bank won't care that the business changed hands. They've been doing business with the first guy, for 20 years. They'll treat you the same. You don't have the same risk. Other banks are like, I run the tax ID number through my algorithm. It says you're 4 days old. I'm not going to give you a penny. It happens all the time. And all of a sudden you're like, wait a minute, this business has been around for 20 years. Nothing changed other than I bought it. The management team is here, the staff is here, the craftsmen are the same, and it doesn't matter. This tax ID number you gave me is brand new. We give you no credit for the fact there's 150 years of experience in your shop.
Yeah.
So it's just things you got to plan for, and to have a clear view pre-close gives you the opportunity to negotiate those things into your deal. Again, as another source of liquidity and certainty to execute your business.
Yep. Well, we're about up on time, Chris. Thank you so much for sitting in. Really appreciate your insights. And as always, folks, we'll capture this and post it out on our archive of our AP calls. But thanks, everyone, for sitting in. I hope you have a great holiday weekend, and we will see you next time.
Thank you.
Enjoy
Thank
it.
you.
Thank you.